All right, let's get started. My intent today, hopefully, is to talk for 15 or 20 minutes or so, and then turn you guys loose to work on your projected balance sheet and whatnot. Remember, next week I would like the financial portion done, right? I think Tuesday is when I have set. Tuesday, Wednesday, one of those days, get it in the Dropbox so it's done, right? So that we can move on to talking about the marketing portion. I think that we've talked about the all the way through the cash flow, right? We did the startup, the opening day balance sheet, the income statement, loan amortization, and the cash flow, 12-month cash flow, if I'm not mistaken. So we're to the point where we're going to discuss the pro forma balance sheet. By the way, anybody that didn't go to the basketball games this last weekend, you guys are just plain nuts. I tell you what, that was the best entertainment value for your dollar that you could get just about any place. Now, unfortunately, our gals lost on Saturday in a double overtime, but boy, what an exciting game. And we had while it's rather small, I wish we had about twice as many students there. We had a student section that was really, really enthusiastic, so I'll give them that. Man, they were getting into the game and having a good time, and it was a lot of fun to watch. So if you missed it, I'm sorry for you. And I know other people have reasons, other things to do sometimes, but I'll tell you what, it beats the heck out of sitting home and playing cards or going to the movie or anything like that when you got good live entertainment. Onward. Here we go. So real brief, just kind of reminders about things that the balance sheet is, right? It's a snapshot of what the company's going to look like, in this case the pro forma, at some point in the future from a financial perspective. It's the quickest method, right, for an investor to analyze the profitability of and the cash generating capacity of a business. He said, when I was in banking, I liked looking at balance sheets, probably more so than income statements and cash flows. I don't know why. For me, it was just easier, especially when you had comparative balance sheets. You know, if balance sheet 1 is beginning 1 year and balance sheet 2 is the end of that year, you know, if the cash went from $2,000 to $10,000, they had positive cash flow, right? I don't need to see anything else. And so I found it to be an easy way sometimes to analyze, at least a down and dirty look at companies. Certain numbers must come right from other statements that we've prepared. Right, we've done an income statement, we've done a cash flow, and guess what? We're going to draw some numbers from those in order to complete our balance sheet. Cash going to come from the bottom right-hand corner, basically, of our cash flow, right? Fixed assets. Do your fixed assets change? Anybody know? No. Right, probably not. Exactly, probably not. The only way they would change is if somehow in that first year you actually projected that you were going to purchase more equipment or machinery, more than what you purchased at the startup. Okay, that usually doesn't happen in the first year. We usually at least don't project that we're going to purchase more in that first year, or that you might sell some machinery and equipment in that first year. Again, that would be pretty rare that we would project something like that. Okay, so do they change? Probably not. Okay. Otherwise, the only changes to fixed assets is in the accumulated depreciation. Okay. And you actually, there's a net then in your total assets or total fixed assets that comes when you deduct your accumulated depreciation. Long-term and CPLTD must come right from the amortizations, right? They could come. Nope, they must come right from the amortizations. I'm sorry. I was going to say something else, but that would have been wrong. So they must match the principal payments on the cash flow. Owner's equity, what changes this account? Well, there's a couple things, right? Retained earnings are going to increase your owner's equity. Okay, and that has to match the net income from your monthly income statement. So from the bottom right-hand corner of your income statement, you have that. Oops. But and this, I'm going to have to add that to it. Your retained earnings then will be decreased by your owner's withdrawal. When you do that reconciliation of owner's equity at the bottom of the pro forma balance sheet, you also have to include in that your owner's withdrawal, which should come right from your cash flow. Okay? Just the total number from there. So that's that's pretty much it in terms of what it looks like. Or the basics of it. Let's go take a look at what it looks like. and give you a few practical things to look at here. Okay, please, 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 I don't know how many times I've had to look at these, and oftentimes in business finance more so than in entrepreneurship, but your historical column is exactly like your opening day balance sheet. Okay, you can basically copy and paste or link every single number from your opening day balance sheet into the historical column. That's what I want in there. Okay. It's the projected column that's going to project what your company looks like at the end of year one. So please copy or link would be the proper term, each and every number from your opening day balance sheet into this historical column. Your cash in bank comes from lower right hand corner of your cash flow. Okay, if you guys got this opened up, you can make little notes over here, right? Might not be a bad idea. Lower right hand corner, oops, of cash flow. Okay, accounts receivable. Do you have any accounts receivable? Thus far, only one person has talked to me about actually doing accounts like that. Okay, and that's Macy. Okay, so she will have some accounts receivable. Okay,
and that's like on credit.
Right, right. If people are doing business with you on some sort of credit, then you might end up with some accounts receivable. Okay, so Macy's going to have a little accounts receivable unless somebody else talks to me about that, right? Because there's some different things we got to do on the cash flow and stuff then too. You probably won't have an accounts receivable. Inventory, please, right over here, you can put, right, ending inventory equals what? You guys remember what the equation is from your accounting? Beginning inventory plus what?
Purchase inventory.
Plus purchases. Very good.
Minus cost of goods sold.
Minus cost of goods sold, exactly. Okay. Your beginning inventory is going to be right here, right? Because that's on your open day balance sheet. Your purchases are on your cash flow, right? Your purchases are on your cash flow. Your cost of goods sold comes from your income statement, your monthly income statement. For many of you, for a whole bunch of you, your ending inventory may end up equaling your beginning inventory. Okay? It's just going to depend on how your purchases work out versus your cost of goods sold, whether you're seasonal or different things like that. Okay? Prepaid expenses, likely the only prepaid expenses that we would still have here that might carry over, and they might, would be those deposits, right, where we might have a rent or utility deposit.
What about like prepaid insurance? That wouldn't be under projected, or just under your historical.
Yeah, the question here was, how about your prepaid insurance, which we did show as a prepaid expense right on our opening day balance sheet. Maybe, okay. If you showed that you're going to pay that in December, for example, and you're going to have this cash outflow in your December cash flow, then it would become a prepaid expense again, kind of like we did in the startup. Okay. For most people, I'd say, let's not complicate it. Let's just say we're going to pay it January 1, right? Then technically it wouldn't be a prepaid expense at that point in time. So if you want to show it that way, I don't have any problems with that. Okay. Other current assets, we probably don't have any. Machinery and equipment, again, just stays the same, so you can just link those right over. Accumulated depreciation, that comes right from our total on our income statement, right? From total on income statement, remember, as a negative. So put it in as a negative, right? Negative number. Our accumulated depreciation is a negative number. Other assets may have had some. You know, it actually shows deposits down here. I probably have them up here in prepaid expenses. If you put them down here, that's okay. Accounts payable, we probably don't have any. Okay, I don't think too many of you are accounting for it that way. And usually on a projected balance sheet like this, I wouldn't get too concerned about it. In real life, you might end up with something like that. So interest payable, Okay, the exception might be if you're purchasing some real estate. Okay, if you're purchasing some real estate, because you're going to pay your first half taxes in November, you might actually have second half taxes that would be due in May. Okay, and technically that would be taxes payable, right? Because they've accrued, they're owed, but they're not due until May. Taxes. Okay, but that would only be property taxes, right? So not income taxes, not any of those things. Remember, if your business is anything but a C corporation, it does not pay taxes. You do. Okay, other than property taxes. Your business will pay property taxes. Okay, current portion of long-term debt. If right here your CPLTD is the principal portion of your long-term debt for the first 12 months, what's this one? So what's this one going to be here at the end of year one?
The following years?
Yeah, principal portion of your payments for the next 12 months. It's for 13 through, payments 13 through 24. All right, so you do it the same way from your loan amortization. You just plug in your sum. Okay, away you go. Bank loans payable, okay? If you guys got your statement up right now, just do this. Just say this is equal to my total long-term debt right here, right? Because what we've done is we've taken our long-term debt in year one. We've deducted right here the short-term portion. So at the end of the year, this should be what our long-term debt is. And so that's going to be the start of our long-term debt for year two. Right.
Your total long-term debt from the first year?
Yeah, this is what your long-term debt's going to be at the end of the first year, so it's going to be your long-term debt at the start of the second year, basically. Okay, so if you put that in, then you put your numbers in here, it's just automatically going to do that. Great. Other long-term debt, we probably don't have any. Owner's equity, please go ahead now while you're sitting there. You know, put in a, oops, I'm going to come down one more, I'm sorry. Right here, insert a row. I should have. I'm going to do this just because then it'll bring down all the little lines and everything. But then I'm going to put in here, owner's withdrawal. Okay. You won't have any here, right, because that was before you started. That's your opening day balance sheet. But here you should have an owner's withdrawal that's going to be equal to whatever that total is on your cash flow. Right? From cash flow. If you've done everything right on your income statement and you've done everything right on your cash flow, and then you link these in properly, your pro forma balance sheet should balance. Okay? And you can kind of pop the champagne cork then, but don't get carried away because you're still going to have a little more work to do. But you could have a sip, right, or two, assuming you're 21. I don't want to be encouraging underage drinking here. Okay? Any questions about that?
I have a question.
Yep.
For assets or the other assets, would that be like when my advertising or prepaid advertising expense, what would that do then? On the historical?
The question was under other assets, would you might you include some of the advertising things? Very possibly. If you've got some long term, I would say.
Well, because on my opening day balance sheet, that's underneath other assets. I have the advertising expense prepaid and then my supplies. But then on my projected, it didn't have like, it didn't say
Okay.
So I just added it.
Is it going to be on the projected? We're going to have to look at two things, okay? It might be on your startup expenses, but then is it on your opening day balance sheet?
Yeah.
Okay, it was on your opening day balance sheet. Then we have to look at the income statement. If you wrote it off like your prepaid insurance on the income statement, then it won't be on the projected balance sheet. But if you didn't write it off, like let's say it was you bought a big sign that you hung, or an awning or something that you put up over your building or something, that you should be depreciating that, okay? And so that should be handled just like a fixed asset where you're going to have some depreciation and whatnot. And we'd actually probably move it up into that fixed asset category on this particular balance sheet.
Yeah, I might need help organizing all those advertising, because I have that extra sheet with all the different advertising things.
Okay, no worries. No worries. Any other questions about the pro forma balance sheet? Okay, I want to hit one more thing, kind of quick like here.
Which ones are supposed to equal on that projected balance sheet?
What's supposed to equal? What's supposed to balance? Total assets equal total liabilities plus owner's equity. So total assets up here have to equal total liabilities and equity down here. Okay, the other thing I want to take a look at today, because you'll do it. I don't remember if we did this in business finance or not, but it's the break-even point. And I don't know. Let's see here. I got a break-even point. I don't know if I have a break-even point for the PowerPoint. If I do, it's really short. Yeah, there it is. This is one that a lot of folks don't like to do, or they don't do it when they're actually pursuing a loan at a bank or a financial institution. And this was one of the more important forms that I really like to look at, and I'll tell you why. Probably about 90% of folks that came in to see me at the bank, and they had a business plan or whatnot, okay, and they'd have projected income statements, and they'd have all that. And when I'd look at it, of course, they were projecting that they were going to do $2.5 million in sales of widgets. Okay, and I'd look at that and I'd say, for the life of me, I cannot figure out how somebody's going to sell $2.5 million worth of widgets in Havre, Montana. It just doesn't make sense. Okay, and of course they were showing that they were also going to make a profit then of $847,000 or whatever, right? And I'd look at it and I'd say, oh, come on, you're nuts. There's no way anybody's going to sell $2.5 million of widgets in Havre, Montana, and make $850,000 profit on those sales, right? But what I could do, if they did a break-even analysis, I could go and I could look and say, well, you know, your break-even says that if you do $500,000 of sales of widgets, you'll still make $40,000. That kind of makes a little more sense to me. I can actually reason that number, you know, $2.5 million, ain't gonna happen, right? And it depends on what the business is, obviously, and whatnot. But the break-even point usually gave me a real point of realism, because a lot of people were overly optimistic when they were doing their, I shouldn't say a lot of people, probably about 95% of people when they came in with business plans, I thought were overly optimistic with their business plans. Okay, and so the break-even point gave me at least a little bit of realism. So, okay, so real quickly, yeah, there's just a few slides here. So basically what I just said simply looks at the company's contribution margin in relation to its fixed costs. Okay, when those of you that have had me in senior seminar, you know the contribution margin is a big deal, right? It's just your total sales minus your variable costs, right? Gives you your contribution margin. So you take your contribution margin. That's what dollar of, how much of every dollar of sales you can apply to your fixed costs, right? So if your fixed costs are $2,000 per month, and your contribution margin is 50 cents, or 50%, I'm sorry, 50%, guess what? You need to do $4,000 worth of sales to break even. Okay? It's really that simple. Okay? So it's not all that complicated. Difference between sales and variable expenses, including cost of goods sold. Got that. Variable expenses presented as percentage of sales. Only those expenses that change in proportion to sales. You know, in our game that we play in senior seminar, of course, those expenses also include variable labor or labor cost, right? They attribute their labor directly to the production and whatnot. okay, to the cost. For most of your businesses, you won't, right? If you're in a retail business, it's really hard to say that your labor has changes in direct proportion to your sales, right? If you're down here at Master Sports and all of a sudden you have 3 weeks that, all hell breaks loose and you're just selling things right and left going out the door, okay, you're probably not going to really change your labor. Certainly not in proportion to your sales. That's one of the main reasons you like that. It's because all of a sudden you're increasing your profits, your overall profit, because your labor cost has stayed relatively the same. So very few of you will actually have a variable labor cost. Okay, very few of you would. The types of businesses that might have labor costs that are directly attributed to the sales might be something like if you were going to run a diesel shop, you own it, but you're going to hire 3 or 4 diesel mechanics, right? You're going to charge the customer $50 an hour, and you're going to pay your mechanic $30 an hour, and the other $20 goes to the shop, etc. Right? Okay, that would be the type of business that might. Okay, if you had a commission-based business, that would as well. And if you had a real estate company or whatever, where the people that worked for you, the only thing they got was a set portion of the commission, then you'd have a direct variable cost. Otherwise, probably not too many of you are going to have that. So it's going to be pretty much your material cost, material and/or cost of goods, which in a retail sense is going to be what you pay for your inventory then, right? Okay. Cost of goods sold is presented as a percentage of sales, right? Something that has 100% markup has a 50% cost of goods sold and a 50% gross margin, right? So don't confuse markup with gross margin. Fixed costs, everything else, right? Should come directly from the totals on your first year income statement. Okay. And if you've got that, if you want to, when we get to that, we can sure take a look. But it's going to be pretty much everything else that's on your deal that's not a variable cost. So, okay, the break-even analysis is relatively simple. Okay. Up here is where you have your inventory or materials, okay, and for all of you, I think, this is probably going to be the only thing that you enter in as a percentage, right? So if you figure out that your cost of goods sold is 40%, some of you may not have even a cost of goods sold, right, because you don't have inventory. You're strictly doing a service business, okay? Then it's going to be zero, right? In which case your break-even point is going to equal your fixed costs ultimately, right? Okay, we'll go through the exercise still. You'll know how to do it. But for a lot of you, let's say if you're, if your cost of goods sold is 60%, you'd put in 60%. Then you'd put in all your fixed costs over here as dollar amounts. So this is a percent. These are dollar amounts. And then you'd end up with your break-even sales. You could also do, and if you wanted to do, and it's got it here, okay, principal portion of debt payment, that would be a cash flow break-even. There's an income, a net income that's a break-even point, and then you could also do a cash flow break-even point. Doing both would take a matter of a few other seconds. Copy and create another worksheet, and then add whatever your principal portion of your payments are, basically. Okay, and maybe your owner's withdrawal. That would be your cash flow items that you'd add. So, could sure do that. Any questions about the break-even? Okay, mess around with it. So everything's kind of due next week. On Wednesday, we'll talk about the other statements that I'm going to have you do, and that's a longer-term income statement and a longer-term balance sheet. If we get your pro forma done, then those other ones will fall into place pretty easily. Okay, trust me, those go pretty slick. And so, if you can get as much done on your pro forma balance sheet before Wednesday, that'd be awesome. Because then I can come around and even show you stuff, about the extended one. I'll talk again for a few minutes, and then we can go. So, okay, questions? Going once, going twice, gone.